Well, for those of you who are joining us, thank you so much. We really appreciate you being here. This is an event that we put on. Actually, every 2 weeks, we're doing guest speakers. This is through Cal State University Fullerton. We're an educational university, and we've decided to open our doors and help out other startups who are outside of the Fullerton area. So thank you for those of you who are joining us from all different parts of the world. We're here to help educate entrepreneurs. And in today's topic, we're going to be talking about raising capital. And I'm going to be passing over to Travis to introduce himself in just a second. For those of you who are new to starting up a business, we run an incubator. It's basically a program where we help you for the next 6 months. We help you on a weekly basis in your startup journey. And if you haven't embarked on a startup journey yet, there's a lot to learn. Anything from understanding who your customer is and how to go to market, getting your product market fit, and then building your team, and then of course raising capital. So there's a little bit of a sequence to this. Sometimes we find a lot of people, they'll start off with an idea, maybe they might already raise some money from friends or family or even their own personal savings without understanding who their customer is. And lo and behold, with that, they will soon run out of money because without customers, you have no business. So it is important to get the foundation correct. So we teach entrepreneurship and we walk you through it. So I will put more information about our incubator into the chat. And with that, I will go ahead and hand it over to our presenter for today, Mr. Travis Lindsay. Please introduce yourself and take it from here.
Hi, thank you very much, Philip. My name is Travis Lindsay. Let me pull up my screen so that you could see that. So there is my LinkedIn, and apologies. I mean, I think that this is going to be one of those presentations that is punctuated by a lot of disappointments. First off, the first disappointment of the night is that John Jackson was supposed to be the presenter here, but he was unfortunately unable to make it at the last minute, so we changed it out. So you've got me instead. Hopefully I'll be able to fill in adequately for him and teach you a few things about startup funding that maybe you didn't know. And on that point, there's the second letdown of the night. It's about startup funding in general. It is very hard. It is very hard to get funding. I've worked with a number of startups, and as you can see, if you're looking over at my LinkedIn right now, and I did add it over to the chat, my LinkedIn link. I'll add it in again there later on. But as you can see, one of the things that I've done is that I'm a co-founder of an investment fund. It's called Titan Angels. John Jackson is the manager of that fund, and primarily we're investing in very early stage companies. So these are companies that are usually pre-revenue, they're just starting out, maybe they've raised a little bit of money, but frequently we're the first people that they will talk to. We founded Titan Angels, if we look down a little bit, back in 2017. We're on to our second fund now. In total, we've invested in 30 different companies, and total dollar amount invested is around 900K. So we usually invest in the 25 to 50K range in these companies, and we're pretty agnostic in terms of which industries we invest in. But what I could tell you is that to get to those 30 companies, we've probably seen probably about 1,000 different companies in some form or another, and passed on the vast majority of them. So you could do the math there. There's 970 that we've seen and we've passed on, and 30 that we actually ended up investing in. And you could click through and see more of that, but this really isn't about me. The other thing that I'm going to mention beforehand is that this presentation is going to be maybe a little bit different than probably what you're used to with these kinds of presentations, where it's just the PowerPoint and I talk to you for 40 minutes or however long it is. And that's pretty much it. There'll be some questions at the end. There will be some of that, but I do want to try to leave as much time as I possibly can for your own questions. I mean, I think that this is a topic that all of you are familiar with, and you have very specific questions that you want answers to. And so my talk is going to be more high level. It's going to be focused on the basic generalities of funding from, early stage to a little bit later on. And to that point, one of the things that I did earlier, but I'll do it again because I know some of you have joined a little bit later, is that I'm going to share with you the Dropbox folder I have for this talk. And that includes my presentation. It includes John Bradley Jackson's presentation that he was going to give. Both of them are funding. And then also some other documents that I think are, really useful for you. And I'll go over a couple of those right now. So first off, this is John Jackson's presentation. We'll get to that in a second. But a couple of the documents that I really wanted to share with you that I think are really solid and can help you out quite a bit are these two. One is an example of a pitch deck. This is for Crunchbase. As you can see, it's a Series C pitch deck. And I'll go into that, into what that means a little bit later on. But basically, the way that venture funding is broken up is it's broken up into different stages or series. And so, like I said earlier, Titan Angels, we invest in like the seed, or sometimes even called the pre-seed stage, which is like the earliest stages you could have for having outside investors invest in a company. And then for each subsequent stage, it's called, Series A, then Series B, then Series C. And there's no hard and fast rules about each of those different series of investments. There's some generalities that are to them, but the main point there is that it just helps people understand, okay, this company has raised 4 different rounds of investment because it's on Series C now, and it did a seed round of investing, right? So seed, Series A, Series B, Series C. So this is the Series C pitch deck for Crunchbase, and I'm not going to go too much into it here because, again, we're short on time. But basically, what this is just a great example of what you can do with your own presentations, whether you're giving it to people that could potentially invest in your company, potential partners for your business, potential customers, or maybe even use it internally as well. And one of the things that I like about this presentation is that it really mixes together hard numbers, and you'll see that if we click forward a little bit. Yeah, so stuff like this is how much money they're making and how big the market is. But it combines those hard numbers with the huge opportunity that they're mining here with their business. And basically what this document is just a really good example of how to put together a pitch deck for your business, and maybe something that can give you some inspiration. The other document, again, this one is also from Crunchbase, and actually I'll just leave it at that size. And it is the ultimate guide to raise capital for a startup. So right now, if you wanted to, if I'm just boring you to death, what you could do is you could click that link that I put in the chat, and you could find this document along with all the other ones, and you could call it a night. But one of the highlights of this document is that it really does go down. It's partially a sales document, don't get me wrong. But it does really dive down deep into some of the stats about raising money. And for example, here it shows like the different stages of funding rounds. So from seed to early stage. And as you can see with this chart, like I was saying a little bit earlier, with each successive stage of money that you're raising, all the way from seed to, IPO, it doesn't show that there, but you're raising more and more money with each round because you've proved your business out a little bit more and you need more money to go after a bigger opportunity. So it gives you good overviews of all that, where that money is going in each round, kind of breaks it down. And again, these are guidelines. There's exceptions to these rules. I've seen some seed companies raise, a little bit more than $3 million, for example. So there's differences. These aren't hard and fast rules. And then let me see if I can find it real quick. There's one last page here that I really like from this document that I think you'll like too. And what I'm just scrolling past here just is explaining the different types of investors that you will encounter in your journey. And let me see. Yeah, so if you're looking for like which slides to include in your pitch deck, which stuff to really focus on, what they've done here is just created a little chart that goes and at the top are some of the top level startup venture capital kind of people, and then what kinds of slides and even how many slides they're looking for in their presentations. So again, good overview stuff. That this helps you center your efforts on what actually matters, because you could go online, you could see so many different recommendations on what to do, how to do it right, et cetera, et cetera, et cetera. But this is just a good way to really narrow down exactly what you're looking for. So yeah, I would, for me, if I was in your position and just starting out, this is something that I would start with, just to, again, center and narrow down what exactly it is that I'm going to be working and spending my time on. Focus on like these slides and focus on some of the stuff that it talks about here and that I'll be talking about in my presentation, and build the content off of that. So there's that. And then in that link that I provided in the chat is, among other things, John Jackson's presentation. And what I liked about his presentation is that he does get to some of the more like just the statistics of startups and this whole industry in general. So he has some vocabulary lessons for startups. And one of the things that I want to focus on here that I didn't really focus on in my that I will focus on in my presentation is something that every investor is looking for in the startups that they invest in, that you have a really clear problem that you've identified. And we really want you to be focusing on what that problem is, because the solution for that problem, is going to change over time based off of information that you gather. And if you're using like the lean startup process, the more that you talk with your customers and other types of, stakeholders in your industry, the more information you're going to get on how to actually solve that problem. So we really want you to find a problem that is big, that is, largely unaddressed, and it's something that you are finding and developing unique solutions for. Let me see. Beyond that, here are some more sobering statistics for you. I mean, I was telling you earlier, Titan Angels, we've invested in 30 different companies and we've seen, 1,000 or more. Here's some statistics. Out of the 600,000 startups that are created annually, 57% of them are funded by personal savings or like credit cards, literally. 38% receive funding from family and friends. And then there's only about 0.91% of startups that receive any type of outside investment, right? So out of all the companies out there that get started, most of them, they don't receive outside money early on. And so this is something that I tell people that, are meeting with us, that are trying to get funding, to keep in mind, is that it's a very difficult game to play. It's a very difficult thing to do, to raise that money early on. And what a lot of investors are looking for is some form of traction, so that, they're not just putting money in for something that is just an idea. It's an actual business, or at least something that's getting closer and closer to a business. And then the last stat there, which I think is pretty powerful, is that only about 0.05% of businesses are funded by VCs. Right. So this isn't something where if you don't already have a working relationship with existing VCs out there, and you don't have a business that really has a huge amount of potential, going from idea to, pitching to a VC firm in a week, that's not likely. That's probably not going to happen. So that's just something to keep in mind. And then the rest of it, there's a lot of overlap with what I'm going to present. So why don't I just get into my presentation? And this is, something more about my background, is that for a couple of years there, for about 10 years, right after I got out of school, I worked at Cal State Fullerton. I worked for the Center for Entrepreneurship there, along with Philip and John Jackson, and helped, found the incubators that are there. And then for the last couple of years, right around the time where COVID started and we were virtual for a couple of years there, I actually became a professor for entrepreneurship, and then also at the MBA level. And so this is one of the class lectures that I used. And it's, titled Raising Capital, Getting Funding and Financing, or maybe a better way to put it is Raise or Die. Maybe it catches your attention or maybe not, but it is true. It's one of those things where if you don't have enough money to do what you want to do, then it's inevitable. Your business is going to end up failing. So you either have to rein back in what you think your overall business strategy is and do it cheaper, or you have to raise the money that you're looking for. And sometimes there's no way to, rein back what it is that you're doing. So you either raise or die. So the main reason, from an investor's perspective, and then also from a lot of, startup founders' perspective, the reason why you raise money is to get faster growth, right? So you have an idea and you can make it work for $10,000, but you can do a hell of a lot more if you have $1 million to invest and get stuff off the ground, buying equipment, hiring people, whatever the case may be. So raising money, generally speaking, the main benefit of it is that you get faster growth from it. And for startups, investors are looking for, and I don't know if this, I really haven't heard this term just in the general day-to-day in a long time, but basically what investors are looking for is what's called hypergrowth. And so it's something that can go from being a $10 million company, in 2023, and then by the time 2027 runs around, it's gone from $10 million in 23 to, like $1 billion in 2027. So it's something that has that potential. It's not that it's going to do it. Most of these companies don't, but it has that potential. Companies that don't have that potential are ones that are going to be more, locally bound, right? So it's the smaller kind of like mom and pop shops. They're not going to usually get the kind of investors that we're talking about here. There are exceptions to the rules, right? I mean, you could create McDonald's and then you're going to get investors over time, but they didn't start out with getting a bunch of outside investors. So examples of this would be something like an Amazon, right? And they use the money to build out their infrastructure, to hire people, all sorts of different things that it would have taken them many, many, many years to do. And they probably, wouldn't have done it, because you need to have that kind of quick growth in order to actually do some of this stuff. Now, the flip side of that is, and I think that a lot of investors have, encountered this and have been dealing with this for years now, is that a lot of these hyper growth companies, like the Ubers, the Twitters, the WeWorks, and some of these examples, are slightly old now. But what happens is that, they grow really fast. So they grow in terms of the number of users, maybe even in terms of revenue, or in terms of total reach. But the trick is, from an investor perspective, is can you get these companies that grow really fast to actually also produce a lot of profits? And it doesn't always work out. It usually doesn't. I remember one of the things that I remember reading a while back was that the amount of time that public companies stay on like the stock exchanges has gone down from like 30, 40 years from like 100 years ago to 15, 16, 17 years today. So a lot of those companies that were really high flyers early on, they were never able to really figure out how to turn the page and become profitable in a sustainable way. So still, what I'm saying here is that the investors are still looking for those companies that have that potential to be hyper growth, with the hope that they could turn it around and also become hyper profitable. It doesn't always work, but if you are looking for those huge returns, and some of these investors are looking for gigantic returns, right? So, I mean, you're usually thinking in terms of percentages over year from, 5% to 25% if you're doing really great. Startup investors are looking for anywhere from 10 times their investments to 50 or maybe even 100 times their investment whenever they invest. And that's something we'll touch on again a little bit later on. And again, we don't have too much time for all this stuff. So again, this is just going to be an overview of stuff, and then we could delve deeper into individual subjects at the end here through or during the Q&A session. So here's an example of Uber's long road to profitability. I don't think it ever actually has gotten there. If anything, it's gotten worse, especially since the pandemic. When nobody was driving or going out, it was a problem. So there's also some information here, a link to a Wharton article on Uber's profitability. But just to hit that point home, investors are still looking for these kinds of companies that can grow really quick, bring together a huge user base, and have that potential for a lot of profitability down the road, even though it is very much higher risk than something that might be more circumscribed in its overall goals, and that is just looking to grow in a specific area. But because Uber is all over the country, all over the world, really, it still has that potential, if they could just figure it out, how to make billions and billions and billions of dollars off of it and become, worth hundreds of billions. So that's the mindset of the investor. They're looking for huge home runs whenever they invest. Now, what if you're not one of those companies? What if you don't have one of those companies, or not even looking to build one of those companies? First off, I think that that's probably a better way to go. Individually speaking, it's up to you. It's what you're after. Some people psychologically are more geared towards having that like higher competitive type A kind of I'm gonna win it all sort of attitude, but those companies fail at a much faster rate than companies that don't go for super hyper growth and try to bring in tens of millions or hundreds of millions of dollars in investment so that they can grow their business to be worth 100 billion plus. So this is where most businesses fall in. So there's three main reasons startups need funding, right? So it's cash flow challenges, capital investments, and lengthy product development cycles. Now, for an example of a cash flow challenge, basically every consumer manufacturing goods company that I know of, any company that makes a physical product, they run into these problems all the time because they need to basically build the inventory, sometimes months, if not more, out before they actually sell it. So they need funding to do that, just to fund their inventory. Now, another example would be a capital investment. Maybe you're Knott's Berry Farm and you're looking to expand your theme park. So you have to buy land that's adjacent to where you are right now. So you have to either have that money in your bank account, which is unlikely, and even if you did, it would put a lot more risk on your company, or you could borrow it from the bank so that you can build out, expand your park, and then you could pay off that loan or that investment potentially through the increased profitability of that extra location would give you. And let me see, and then lengthy product development cycles. Some of the companies, a couple of the companies anyways, that we invested in through Titan Angels, and ones that definitely need some type of external funding to work, are any like medical device or drug companies that you could think of, because the process of going from research to develop, or the whole R&D process takes a very, very long time, because I mean, A, you're talking about people's lives. B, you're coming up against one of the hardest regulatory bodies in America, the Food and Drug Administration. And so the FDA has many levels of approval that you have to get through, and that could take years to do. And if you don't get that approval, you know, that could set back your timeline by a couple of years. So I think the stat that I remember seeing is that the new drug development cycle is usually a decade. And so if you're going to do that, you either have a ton of money just, you know, sitting in your bank account, or you have to raise money externally. And that's what a lot of these companies do. And the hope is, of course, is that, okay, well, we invest, you know, $10 million up front. Somewhere down the road, this $10 million is going to be worth, you know, $500 million, or, you know, $100 million, whatever the case is. But whatever the case is that it's going to be a better return than what they could get in the general market. So sources of capital, you got personal funds, what you got in your pockets and your bank accounts, depending on which bank you're at. And if anybody has any questions about SVB and any of the other couple of bank failures that I've heard about the last few days, we could talk about that later. I apologize, I probably won't be able to add too much color to that one way or the other. I know the general information about that. I probably know as much as you do, maybe less, maybe more. But yeah, so you can use personal funds, debt financing, equity, or there's other creative sources that you could use when raising money. So personal funds, this is what, honestly, the vast majority of startups that even I work with, and all the ones that I see start off with, right? So you've saved up some money and you're really feel passionate about this idea, this business that you want to start. And so you start putting your own money into it to pay for maybe some equipment that you need. One of these startups that I'm working with as an informal advisor was a former student from Cal State Fullerton and in the engineering school. And for example, he recently used his own personal funds to buy some 3D printers so he could do some rapid prototyping for the business that he wants to start. So that would be an example of something that you could do with that. You know, other examples would be if you want to start up a shop on Main Street. You know, you probably could save up, you know, hopefully you could save up enough money to, you know, pay for the lease early on, pay for inventory, to do improvements to the space as well. And so those are the sort of things that you could do with personal funds. It's usually not a whole heck of a lot that you could do with it, but there's ways that you could do it with your own personal funds, and it is a good way to start. So there's also some other sources of personal financing, and one of them would be bootstrapping. And basically this is a euphemism for being creative with how you actually spend your money and how you get value out of everything that you do. We have here a few examples of what you could do to bootstrap your company. And this, again, just creative ways to get done what would be easier to be done with money. But since you don't have it, you got to figure out different ways to get stuff done. So one of them would be to buy used equipment, right? So the guy I'm informally advising, instead of buying new 3D printers, he could have bought used ones, or he could have rented some time on a 3D printer and did it that way. It would take longer. Maybe there'd be some more headaches using a used device than a new one, but you could save sometimes tens of thousands, even hundreds of thousands of dollars by buying that used equipment over the new stuff. And so it's always something to look into. Some other forms of bootstrapping, you know, get payment in advance. You know, buy items cheaply, coordinate purchases with other businesses, right? So maybe you're a restaurant on a busy street and you could work together with the other restaurants to buy some common items that you all use. Minimizing personal expenses. I mean, this seems so obvious and stupid, but it really is a big thing. So you're going to have to be wary of how you spend your money. Especially, again, if you're trying to do something, if you're trying to build a business, you know, spending extra money doing something stupid, you know, frivolous, or maybe fun, maybe you're going out to the movies a lot or whatever the case may be, but all that money that you're spending on stuff that isn't providing a high ROI for each dollar that you spend is a dollar that's going away from making sure that your business is successful. So I don't want to, you know, sound like the Grinch here, but it really matters where you spend your money. Sharing office space, and then the last one there is, you know, consider interns. Some of them are great, some of them are not. So you have to really look into that and see if it's something that would fit with you, and don't expect too much from them, right? So they're not going to, you know, file patents for you and, you know, do everything for you, but they can be very valuable in a limited capacity. So here's a little 3-step slide on raising debt or equity. You know, first thing you got to do is really determine how much money you need. And the only way that you can figure that out is if you have at least a somewhat detailed plan on how you're actually going to spend that money and where it's going to go. So this is one of those things where if you are, you know, thinking about launching a business, or you're in the process of it, the more of it that you can have planned at some level. I'm not saying, you know, sketch out like every last minute of your day kind of detail, but as long as you have some sort of idea about how much stuff is going to cost, and you take into consideration all the risks, and you've crunched all the numbers, you've put together your financial projections, and you've done your due diligence on your own business. So you'll know that, okay, in order to, you know, accomplish my goals, I only really need $500,000. So I don't really need to go out and raise $1.5 million, or worse off, you know, maybe you're in a situation where you still do need that 500K, but you think, okay, well, if I just raise 250, I'll be good. In that situation, it really is worse, because you're going to get to that end of that 250K, and you really didn't accomplish what you set out to accomplish. And so that's going to, you know, signal to the investors that, hey, this person doesn't know what the heck they're talking about. I'm not going to give them any more money. It's just good money after bad. So really work through to figure out how much money you need to raise. And then, you know, determine what kind of financing is most appropriate for you. And from there, develop a strategy for engaging potential investors or bankers. I think we'll talk about that in a little bit more detail about engaging investors and bankers and everybody else. So equity, just go over this really quick, because it is a deceptively complex topic. So equity is, you're basically selling a part of your business, right? So in this example, let's say you have a business that you agree with somebody is worth $9 million. That's called the pre-money valuation for your company. Now that person says, okay, I'm going to invest $1 million in your business. And you're like, yes, this is exactly what I need, because I did all that planning. And now I know that I need this $1 million to make this company into a $1 billion unicorn. So what that means is that with that $1 million investment, your company is now worth $10 million, and that's called the post-money valuation. So in this situation, the investor who invested $1 million owns 10% of your company, and you now own 90% of it. So that's just, you know, a pretty straightforward example. Debt financing can be, there could be a couple different forms of it. One that I'm going to talk about here is like a convertible note. Now, a convertible note is something that I encounter fairly frequently. And basically what it is that it starts out as debt. So you invest $25,000, $50,000, you know, $1 million, whatever the case may be. And it starts out as debt, right? So it's basically like you're loaning the company that money. And that money that you invested or loaned to the company, it gathers interest. And then after a certain time, you can either, after a certain time, you have a choice. You can either have the company pay you back, so you get your money paid back plus interest, or you convert that loan into equity in the company based off of a pre-agreed upon conversion rate. So that's something that you can do, and that's something that I have done in the past. And then let me see what's next. Okay, so I think this is actually a really good chart. This was from the book that I was using in the class that I was teaching over at Cal State Fullerton. If there's any students here, this was from 465A management. And so this is just a chart that shows you how to match your business with the kind of investors that you should, consider. So at the top there, high risk, uncertain return. Not only that, it's high risk. It's probably low chance for having a large return. So this could be, maybe you want to start a publishing empire, right? And or you want to start a podcasting empire, whatever the case may be. Very high risk, probably not going to succeed. It's something that's going to take years to do. It's not it's not something that you're going to see most professional investors lining up for. And frankly, there's a lot of those businesses in that top category. This one, the business has high risk with an uncertain return, that if you work on it and you're able to personally fund it and bootstrap it and get money from friends and family, you can make that business into something that really qualifies for that third category. The business offers a higher return, and you would basically make that business that started out as a long shot into something that some people would want to invest in. So those two, and then the middle kind of business is what most businesses in America are, most businesses around the world, really. It's businesses that have relatively lower risk and a more predictable return. So, grocery stores, restaurants, for example, laundromats, a lot of potentially consulting firms, schools even. And so they have strong cash flow, low leverage. They don't have a lot of debt. They have a healthy balance sheet, good management, all that other stuff. With those kinds of companies, they can go to the bank and get a loan that isn't, onerous. It's not going to have really high interest rates because the bank knows that, okay, this company is good. It's going to continue to make basically what it's making now, maybe grow a little bit. And so it's going to be able to repay this loan down the road. But I'm guessing that a lot of you are here thinking that, okay, you're hoping that you're going to be in that third category, high return potential, high growth, whatnot. So you're looking for outside investors, and maybe you still need it. But yeah, I mean, honestly, if I were to start a business, and if I was going to recommend a business for somebody to start, it would be one of these businesses in the middle, if at all possible. Again, just because it is a lot more stable, a lot more higher chance for success, and it's just a lot less risk. All right, so the sources of equity funding, and I think this is, finally almost, 30 some odd minutes into this conversation, we're getting to the nitty-gritty of what the Eventbrite promised. So there's angel investors, of which I'm one, venture capital firms, and there's IPO, initial public offering, or some sort of a direct listing. Now, angel investors, they tend to be older, so 50 years old. I know I look, at least that old, so I guess I fit that way. Usually high income and wealth. They're, well educated, or at least they went to good schools. I don't know how educated they actually ended up becoming. Many of them succeeded as an entrepreneur, and they're interested in the startup process. Either they want, the higher returns, they want to, stay in the game, or for some reason they're interested in startups. There's groups of these investors that are interesting because it's basically just groups of these high net worth individuals that's, kind of grouped together, such as like Tech Coast Angels. And that's a group where members will invest directly in startups. So each member can invest directly. It doesn't invest as a group. Whereas a fund like Titan Angels, we invest as a group and not individually normally. So Tech Coast Angel basically is there to help facilitate those investments, bring those investors and the companies together, and they could talk. The number of angels have been increasing over the years. I don't really know what the numbers are over the last couple, but generally speaking, whenever there's a good startup environment in the country, you're going to see more angel investors. These investors usually invest at the lower ranges, so between 5K and 500K. Some will invest a little bit more. They're looking for really high growth potential companies. They're probably the investors that are looking for the highest potential growth companies. And the reason is because there's so much risk early on in the start of any company that most of them fail. I mean, I think the number is somewhere around like 97% of new companies that receive venture funding or some sort of outside funding end up failing within like 5 years. So angel investors, their strategy is to invest in, a few dozen companies or some sort of diversification in hopes that one or two of them will, be that home run that will return 100x of what they invested. And even, in that situation where they do get those one or two big winners, it's not like they're, making a ton of money off of that. Usually it's, in general, they'll be, outpacing the market by some. Most investors, contrary to maybe what you've read, end up losing money and you just don't hear about them that much. So not all investors end up making a lot of money off of this. One other thing that I should note from that one is that this last point here, business angels, they aren't too difficult to find, but especially early on, if you're looking for an investor that could also help maybe with advising or connections or whatever the case may be, other sources of funding, those investors that have the right fit with your business, they can take some time to find. So that's something that you're going to have to work at. You're going to have to do a lot of networking, asking around, and being prepared with your elevator pitch and what exactly you're looking for from an investor, and be also ready with questions for investors as well, so that you can really find somebody that's a good fit for you. Investor returns, I'll go over this really quick, but basically the investor return isn't expressed like you would see like on the CNBC or Fox Business or whichever one you watch. It's more expressed as a multiple of how much you invested. So for example, in here, if you invested $10 million in the company, which is a lot, if it sells for 500 million in a few years, then your multiple is 50x. So that's usually how we express investor returns. The most common kind of investor return is 0x, because the vast majority of these companies fail. So keep that in mind. So again, the reason why we look for big returns is because most of these companies fail. Now, venture capitalists, so they're looking for companies more, right? So the angels, they may loosen their requirements a little bit and invest in more of like the idea or the founding team, or because they think there's a big opportunity there. But those are more long shots. Venture capitalists are looking for companies, and these are companies that they have the product. They've figured out, how to actually sell it to customers, because that's a big leap, right? I mean, you've got your customers. Even if you do it 100% the right way, you follow lean startup principles, you go talk with your customers every day, you know everything about them, you know all their problems. Still, even if you know all that stuff, maybe that solution you're creating isn't perfect. So venture capitalists, they are investing, a little bit longer in that process, so that the companies they're investing in have a little bit more figured out. So theoretically, anyways, the risk should be less there for them. So here's just a little bit more information about venture capitalists. There's about 1,000 of them in the US, et cetera. Sorry, you can look at this stuff. There's more information here. And they're not investing in a lot of different companies. And one of the things that I found out to be interesting about investors in general is that there's a lot of a herd mentality in the space. So for example, one of the first things that a lot of startups are asked is, who's your lead investor? So basically what that means is has anybody, set the terms for the current round of money that you're investing? And what a lot of investors are trying to get at is, okay, who's invested in you already? And if nobody has, they may, be interested in investing in you, but only after you have received that first investment. So that's just something to keep in mind about investors that you're looking for. You're gonna have to talk with a lot of them. I know in that Crunchbase document that I have linked to in the chat, it says that you should plan on talking with at least 100 potential investors, 100 potential investors. And I think that that's definitely true early on. And maybe it becomes less and less true as you get to the VC levels, because once you get up there, you're more of a known quantity than you are down at the angel level. But yeah, you're going to have to talk with a lot of potential investors. Now, one thing that every entrepreneur should be prepared about whenever they're going for either equity financing from an angel investor, a venture capitalist, or even going to get a loan from a bank, is the due diligence process. And at each stage, the requirements there, the expectations there, vary, right? So when you're very new, very early on, maybe you haven't sold any products, and so your financials are basically just a blank Excel document that you've saved under a different file name, and it's like, hopes and dreams. Or you're a company that's been around for 5 years and you have 100 million customer, users of your product, and you're looking to raise $50 million. Obviously, there's going to be difference in terms of what the due diligence process is going to look like there. And what due diligence means is just that the investor is going to look into your company, ask for information about your financials, capitalization table, business plan, maybe even do background checks on employees. I mean, at least, find out who your employees are, maybe your advisory board as well. And, other companies that have invested in you, which you could see through the capitalization table. And then they're also potentially going to do more research into your competitors, your market, all the technology that you're developing, any patents that you've filed. And basically, it's sort of like, when you go to the doctor to get your yearly physical, whether that's every year, every decade, or however often it is that you do it, it's sort of like that but just in a business context, right? So it's looking to see that everything's sound with the business, that the opportunity that you're proposing is legitimate, that's real, that's possible, that's something that you can actually do. So yeah, that's when investors are going to really look deep into it. And that's, it's just part of the process, right? So, first starts out, you say hi, you shake hands, give them your elevator pitch, then maybe you pitch them for 15 minutes. And then if everything goes well, then they'll go into the due diligence process. In general, at the angel level, the due diligence process is less onerous. So it could take a day or a couple of days, maybe a couple of weeks. But once you get up to VCs where you're talking about investing $10+ million, it could take months. And then also if you're getting loans from banks, they usually have it more standardized. And so you have to fill out paperwork, and that could take a while as well. And I'm looking at the clock. I know we're going a little bit over how much I wanted to, but so let me just get through the last parts of it. And we've already gone through the meat of it. Investors, make money only when the business is actually sold, usually. So if I invest in a company, if it never gets sold off, but it's doing well, that's great. It's good that I helped somebody start a business. But if the company's never sold, I'm not going to see a penny of it. And then there's, you could either get sold or you could go with an initial public offering when the business actually gets listed on a stock exchange, or something called a direct listing. I know there's, more technical terms for it. But that's where you basically have a startup that takes over an existing company that's already on a stock exchange so that it could be traded in the public markets. So there's more information on IPO. Honestly, for most businesses, or the vast majority of businesses, they're not going to go IPO. It's a pain in the butt, and for the most part, companies that get to that point where it could potentially start even thinking about IPO, they're going to get so many acquisition offers that it just makes more sense to get bought out by somebody else. Sources of debt financing, you got the commercial banks, which last few days kind of makes that discussion a little bit more interesting. And then you also got SBA guaranteed loans. Now, historically, commercial banks have not been viewed as a practical source of financing for startup firms. Maybe that historical view is going to come back somewhat for the next, year or two, depending on what happens, with SVB and a couple of the other banks. I know there's one in New York and one in San Diego, slightly different. But yeah, so in general, banks, they look kind of askance at startups because they don't have that history of financials that a more stable company does. And so they're not going to be as likely to hand out loans to startups. There's exceptions. One of them would be like an SBA guaranteed loan, and I wish that we could go into this more, but basically this is a government-sponsored program that guarantees loans made by traditional banks to small business owners and people in the private sector. And there's more stuff that you could look in through here if you have any questions about that. I think I could connect you with some people that are in that space. These loans generally aren't gigantic, but they can help you, start a lot of businesses. Other sources of debt financing, there's vendor credit, where a vendor will extend you credit so that you could buy and, pay them later. There's also factoring, where you could sell off your accounts receivable to other companies. So, if you sell your goods on credit to your customers, maybe it's going to take you 30, 60, 90 days to get that money paid, but you need it now. And so you sell it at a little bit of a discount. So that you can have that money now to pay for your business, what you're doing. Let me see, merchant cash advance, and different types of loans, some peer-to-peer lending. It's caught on somewhat, but not a ton in my experience. And then here's some other ones. And you can look into this. I'm sure you've seen information about all these different other types of funding, crowdfunding. You got Kickstarter, Indiegogo, where you basically get funding before you actually deliver anything for the products that you're making. And each one of these crowdfunding sites works better for certain companies and less well for other companies. There's also some crowdfunding where it's equity based. So basically you list your company, the shares of your company anyways, on these crowdfunding sites, such as like Funders Club. And the people that are there, they can actually directly invest into your company and get some equity in there as well. Leasing, you all know what leasing is. SBIR and STTR grants. So this is one that we could talk about for a while. But what you need to know about it really, and I know that there's 4 slides for it, is that these types of grants, they're really focused on funding research and development in the sciences and STEM. So unless your business has a direct relationship to those funding sources, it's probably not the best option. Although if you do have that connection, then absolutely you should look into it and see what you can get out of there. There's a bunch of different websites, a bunch of different sources on that. And maybe that that Dropbox folder that I've linked to, maybe I'll try to add some documentation into that. That includes links to some of these sources. And I think that actually JJ's PowerPoint also has links to some of these sources as well. So here's just an overview of the different phases for SBIR and STTR grants. There's other grant programs, and the reason why I'm not going into too much detail on this stuff is because there is a lot more technical knowledge that you need with this stuff, and it's a lot more diffuse in the information and all the different programs that are funding this stuff. So you have to look, you have to be, you have to kind of like keep your head on swivel, right? And see what all the different grant opportunities are and really how your business actually fits into that. So you don't want to necessarily go after just any and every grant opportunity that's out there, because they do usually require you to do something or do some sort of research into a certain area. And if that doesn't align with what you're doing, you know, probably not the best, but they are out there. All right, the other another source of funding, and we're almost at the end here, and then we'll get to questions and answers, and I'll say however long you guys want me to. The other potential for funding and building your business out are strategic partners, and this could take the form of potentially like a joint venture. But basically, you have the larger company that is, you know, pretty stable, pretty standard. They're looking for growth, and maybe they'll partner with you on certain projects or on certain products or services. And the older established firms benefit by partnering with, by getting access to creative ideas and your entrepreneurial spirit. And then you as the startup or the smaller business, you know, you get a lot more money and a lot more reach by partnering with the bigger business. You know, an example of this would be like biotech companies that partner with large drug companies. So the large drug companies, they're doing a lot of R&D, but what they're also doing is basically looking and partnering with a bunch of these different biopharmacy or biotech or biopharm companies that are doing this research at a lower level as a startup. And the ones that actually, you know, are showing good promise, they'll acquire those companies so that they can help those startups actually bring their biotech or their drugs to market. So that's pretty much all I have. Do you guys have any questions, comments, or concerns?
Well, first off, thank you, Travis. And I think that was a lot of information. So I'm sure some people, and I see in the chat already, it'd be nice if this video would be made available, highly beneficial. So yes, definitely agree. And we will be making it available for those of you who were able to show up. I did put in our chat our website for our incubator to learn more information, as well as my calendar, so that you can book a time to chat a little bit more about that. Travis is also, you know, as he mentioned it earlier in the presentation, a professor of entrepreneurship. He's also a mentor in our program, as well as an active investor. So with all that information, you know, it's kind of a treasure trove of information here that we have for you. Why don't I go ahead and allow you, anybody who has a direct question, to unmute yourself and ask Travis at this time.
Hey, Travis, this is Matthew. First of all, thanks for the video. Super helpful again, as Philip said. So, you know, really appreciate it. So I am starting a business. It's a retail business. It falls into the, you know, the first two categories. It's kind of like, it's unproven, you know, we haven't done anything yet, but we are pretty confident in, you know, the management, the abilities, the background of the founders at Sura. So we're going for the debt financing. Really interested in the 7A loan. One thing that I was curious about as I'm putting together the business plan for the SBA loan is like, what should be most emphasized in the plans for, you know, startups that don't have any historical financial statements?
Yeah, I mean, this is tough. Maybe Philip, you can add some stuff onto this. But yeah, if you don't have any, history, what do you put in there? So this answer is probably going to piss you off, but the recommendation I would have is to find somebody who is an SBA loan officer and, you know, ask that question to them, or find another company that has received one of those loans and ask them. Because my bailiwick, what I normally deal with is on the equity side of it. I do know some people there, so if you email me, I could try to find somebody that could more directly answer your question, because I think it's kind of technical, right? And the issue with anything on the financial sector is that there's a lot of regulations that surround it. So what could make sense just in general doesn't necessarily make sense within the certain regulatory environment that you're dealing with. So yeah, Matthew, right?
Yeah.
Yeah, if you could email me, and I'll put my email in the chat as well.
I'd like to add, in general, most banks, including even for the small business loans, they like to see at least a year of history. And banks are really not the traditional funders of startups. They're there to make sure that they're making safe investments. You'll find that there are some startup groups and seed investors that are a little bit more open to taking that kind of risk. But obviously, as you can understand, if a company has been more established, has revenues, has customers, is a little less risky. And that's usually what a lot of people want to kind of invest their money into, versus a fly-by-night, someone who just has an idea. They really don't know. They don't know you. They don't know your track record. They don't know if you can actually pull it off. We've seen sometimes it comes down to the team as well. So you might have a great product, great service, but if you don't have the right team, you could fail as well.
Yeah, Matthew, can you go over real quick again what kind of business you're starting?
It'll be retail, so it's a coffee shop. So we're inputting like a pretty huge majority of the money needed for startup capital and like a first few months of operating expenses. I think like what we're most worried about is just having enough working capital on hand, like in case of cash flow or anything, for first few months.
So how much money do you think you're going to need for that?
Not more than, I would say, 75,000. Okay.
So there's also, depending on your appetite for risk, I mean, you can also use credit cards for that, personal credit cards. I know a lot of companies do that sort of thing early on. And again, nothing here I'm saying should constitute, financial advice or anything like that. So please, for the love of God, don't sue me. But if you do, I probably deserve it. No, I know.
On the coffee shop, one of the ways to overcome a complete startup is maybe you buy an existing low budget business and then from there expand. So you have a little bit of a track record and then you add to it. I did SBA financing as well.
That's a great idea. Thanks.
Thank you, Gladys.
Thank you.
Yeah, that was great. Thank you, Gladys. Yeah, so that's something that you could definitely do. I mean, but buy another business with a track record and basically take it over. You're kind of just like wearing it as a suit, and the bank doesn't see it any differently. So that's something you could definitely do. I mean, again, you also have credit cards. The working capital, so as long as you have enough money to start it, yeah, it's tough. Yeah, again, just send me an email. And I did put my email in the chat, so and we could talk about it more.
Sounds good. Thank you very much. Appreciate it.
Yeah. Anybody else? All right, come on, guys. You must have questions. It's 9 o'clock out here in Texas. Please tell me I stayed up for a reason.
I've been working with the military on doing a public-private partnership. I was interested in the SBIR and STTR, but they told me that I have to find what agency is interested in my product. And I talked to the Marines and they said they want my product, but I think it makes more sense not to go through the SBIR, STTR program. What do you suggest?
Phil, do you have any insights into that one?
Gladys, so usually there needs to be a RFP, request for proposal. You can look at on some of these different websites. I believe it's sbir.gov, where you would actually see what they're looking for.
I'm in innovation. I'm trying to do something innovative. That's
Okay.
why I'm going the route that I'm going.
Okay. There are typical cycles, you know, to get into the funding and such. It could take a long time. I would almost suggest if you, I mean, grants are free money. So, you know, there's something kind of nice about that. And it has been a lead source for a lot of people to start up their companies. But I'm going to say, as much as this topic, you know, is really exciting, bootstrapping and getting your early customers, getting early traction is really beneficial. So that's kind of what I'm going to lean more towards. I actually kind of lean more towards the bootstrapping than the trying to seek funding.
So Glass, why don't you think you're a fit for SBIR or STTR?
The head of the Navy that works with business owners like myself who are working in innovation, he says I have to find the military sees that there's a fit for my part, and then how to adapt to current technology. And I'm like, okay, so I asked the Marines and they said they want it. So he suggested SBIR, STTR, which I can do, but they don't give very much funding.
No, they don't. Yeah, it depends on which phase of the funding that they're in. And I know a couple of the companies that we've invested in at Titan Angels, they've gotten SBIR funding. It's a long process. It's kind of drawn out, and there's some, you know, it's usually worth it. I think, Philip, you would agree, but it's not just 100% free money. Like there's nothing free.
No. I'm not looking for free.
Yeah, no, absolutely not. So what are the other options that you've been considering? You were breaking up a little bit when you were talking last, so maybe I missed it.
Well, I have some investors. I have interest from Pemex. I've tried approaching as many of the oil companies here that are working with Pemex, but I can't seem to get a hold of anybody.
Okay, and you want to get a hold of them so that they can invest or so that they could partner
So
with
I
you?
can do in partnership with them, since they would have the higher skilled engineers. Then I have some foundations that are tied to colleges that would work with me, but I need somebody higher than that.
Right.
Because I'm working in a plant-based, weed-based plant biodiesel and aviation fuel.
Okay. Yeah, so there's one strategy that you can employ there. I mean, if you have a good working relationship with some of these foundations at universities, they probably have some connections that would be useful to you. So if I was
okay, yeah, I appreciate the feedback.
Yeah. And so, yeah, I would just try to work my way up through those connections to get to, you know, Pemex and some of the other oil companies that you want to partner with.
Yeah, because I was told to keep my for-profit business and do a 501c18, and then that way I can raise capital through the 501c18 and at the same time have my for-profit business. That way I tackle it from both sides. But I have somebody who will sponsor that part.
Yeah. So I mean, you can have a for-profit business and get SBIR grants, STTR grants. So you know, a whole lot of grants are out there for private companies. If you want, you know, reach out to me and we could talk about more offline, and
yes.
maybe I can help.
Perfect. Thank you so much.
Thank you. Anybody else?
Hi, it was really a nice presentation. Thanks for that. One
Thank
thing
you.
I'd like to know about is like we are seeing a global slowdown these days, which is impacting investment in almost all the sectors. So specifically to my sector, like I'm into fintech space, and we are working on cross-border transactions as well as other services related to fintech, which includes bill payment, recharges, and all. So person staying in one country can do these type of transactions, bill payment, recharge, which is a unique in itself. No company is doing it. So what is the scope of like getting funding in a fintech space these days?
So so you're looking for an answer about what the funding outlook is in the fintech space?
Yes, yes, specifically to fintech space.
Yeah, so it's interesting. Over the years, it's kind of, you know, morphed and moved around a little bit from my perspective anyways. And again, you know, Titan Angels, which I'm involved with, early stage companies for the most part, so fresh startups. I mean, there was, you know, back in 2017, 2018, it was more like micro loans, that sort of thing. And then there's been a few years with crypto that may be coming to an end. As far as, you know, something hot to invest in for a while, I think it'll probably come back in some form one way or the other down the road. But I think that the thing that you have working in your favor is that you're in finance. And for whatever reason, I mean, I think we all know the reason, but, you know, dealing with money, you know, historically forever and ever and ever is one of the better ways to actually make money. So there's always going to be companies that are going to be looking to invest in what you're doing and potentially even partnering, you know, with you. And so can you explain it again? Like what exactly is your unique hook? What is different about your company versus what's available right now?
Okay, so I'll brief you about what we do. We started, like I am from India, we started our company in India only. So we targeted initially the people who are Nepalis staying in India. They are working in India. They have to make fund transfers to their home country, to their parents or family. And also they have certain expenses which are recurring. For example, bill payments, recharges of phone, DTH, and also electricity, water supplies. They need to make the regular payments for that. So we are bridging the gap here, and person can come to our application, make payment for these small petty expenses through our app, as well as they can transfer funds from India to Nepal. So we started this with India-Nepal market. Now gradually we are looking forward to expand our services in other markets as well, where immigrant population is high. So they would be able to send funds to their home countries as well as do all these transactions, bill payments, recharge, mobile, electricity, water, any sort of petty like gas supplies and all. So any transactions related to that, they would be able to do it.
Okay, yeah, no, I know I've heard of, I can't recall which companies do this, but there were a few startups back a few years ago that were doing that sort of that were processing those types of transfers between like America and you know, Mexico and Central America, South America. So there's precedent for it, absolutely. And so you're basically taking something that's been proven to work in North and South America and bringing it over to India, Nepal, and, you know, potentially some other neighboring countries as well.
Yes,
yes.
Yeah. There are companies who are doing cross-border transactions like fund transfers.
Yeah, yeah.
Not exactly the bill payment and recharges, like small petty transactions. No, these transactions are not done so far. Any company is not doing it.
Right. Yeah. And then, I mean, in that area, that broader area, like the Gulf and Arab states, I mean, there's a lot of foreign workers there that probably want to, you know, send some money back
Yes.
to their family as well. And so, yeah, it's So yeah, I mean, I think there's obviously an issue there. I don't know how big that opportunity is. My gut tells me it's a pretty big opportunity, because there's a lot of foreign workers, and so getting those funds transferred in a safe, reliable way, should have some pretty high demand. And so, there's
for a smaller market like Nepal, there are 10 million people, Nepali people staying in India, as well as almost 10 million people staying other than India, other countries. So similarly, if we take example of population of India, like staying abroad, that is again huge. Similarly, South African people staying in other countries, they would also be requiring these things. And there are other countries, people like small developing countries, they have larger people who are staying abroad. So they typically have to send money back as well as do their regular transactions.
Right.
On behalf of their parents, maybe, or if not, then also they have house, which for which they have to incur these regular expenses, electricity, water, and other municipal corporation taxes and all.
Okay, and so remind me, you're asking about what's the best way to raise money for this?
Yes.
Yeah. So there's different ways to do it. If you don't have any connections with investors right now, one way that you could do it is by starting to network. And by that, I don't mean just going to the events and, saying hi to people, although that is important. But there's probably competitions, for example, that you can enter and talk about what you're doing and why your solution is better. And you can, do what you want to do in a safer, more trustworthy way. And so that way you'll get exposure to some investors, because the investors are usually the ones who are judging those competitions. But then, the old-fashioned way of networking, find out where the finance events are, go to those, talk with the people there, tell them what you're doing. It's going to take a lot of time. So, just to be upfront about that, I think I cited this statistic that you should plan on talking with 100 potential investors before you go out and raise money. Yeah, that number, depending on what your experience level is, how big your network is, could be very low. You may need to talk with a couple hundred people before you start really getting results on the funding side. So yeah, that's what I would start doing. The other thing that you could also do is, at least I know it works over here in America and like Western Europe, is you could start writing about your industry and, just talking about the different issues that it faces, and, maybe even like ask to do guest articles in newspapers or websites that are popular in that space in your area. So that way you could get your name out more. You could also position yourself as more of an expert, and, potentially even get the attention of some investors, right? So there's different things that you can do, but yeah, I mean, it's once you break it all down, the best advice is that it's just a damn numbers game. So the more people you get out in front of, the more chances you have to be successful. The good part is that with startups, if you are successful, the rewards are gigantic. And, if you're not, nothing horribly bad's happened. You're still at where you're at. So that's not horrible. It could be really good still. So yeah, that would be my recommendation. Just get out there as much as you possibly can, and try to get your message out there as much as you can.
Sure, that will help me. Definitely, I try all of these. Thank you so much.
Thank you.
Yeah, and I'm also going to add in LinkedIn. Sometimes, it's worth paying the extra money for the premium membership, so that way you can message people and see if you can have some discussions with people. I think we have time for another question. If anybody else has a question, why don't we just kind of round off the evening that way? Again, I'd like to remind you, if you want to talk a little more in detail, I did put my calendar in the chat, and why don't I just go ahead and do that one more time, see if anybody else has and wants to talk a little bit more privately, we can do that.
So Philip, what is the question that you most commonly get asked from people that are looking for funding? They find you, they set up some time with you on Calendly, and they say, hey Philip, I've got this great idea that I've been working on for 5 years. I just need to raise some money. What do I do? Or what's the big question that you get asked anyways?
Well, I really think that a lot of people don't understand that it's really about diversifying the risk for the investor. So unless you really actually have customers, maybe some sort of traction, letters of intent, something to prove that your product or service is going to be successful, an investor really doesn't want to take that kind of risk. Again, they just don't know that your team, your concept is really going to work out. And this is usually why most investors invest in companies, not necessarily startups, but companies, those who already have a team in place and a product or service, and that actually has some sort of traction. So the idea of just getting a whole bunch of money from someone, like you see on Shark Tank, it really doesn't. It doesn't really happen. I mean, I want to remind people, Shark Tank is entertainment. It's TV. Most of the time, they actually do. If you really do pay attention, most of the time they actually do have some sort of traction as well. So that is proof of what I am talking about as well. And then lastly, I think that some people may not understand, again, the use of the funds. It's not that you're going to be making a whole bunch of money from an investor and then you're going to go off to the Bahamas and sip on a Mai Tai while some people are just going to build a business for you. This is
some people who take money to start a crypto exchange might do that. I'm just saying.
Yeah. So I mean, this is money. This is kind of like, think of it like your parents or someone who's just giving you a little bit of money for what you need to build. So a lot of times, if you say the use of the funds is for a website, well, they're going to say, okay, who are you going to talk to for that website? And I'll write the check for that website. Or if it is to hire that person who's going to help you in sales, how much are they going to, how much are you going to pay them? We're going to write the check for that salesperson to join the team. This is not money that's going to just be delivered to you. It's not coming in on a truckload. This isn't a way to make a ton of money. You're really buying yourself a job. And that's when the work starts. With that money, you can scale up. So getting investment does not necessarily mean success. It doesn't mean anything more than you just now have a lot more responsibilities and people that you owe money back to.
Yeah, well, one thing that you said that was, all that was great, but one thing was particularly brilliant. I mean, like when you are going to an investor or, really anybody in business, you got to think about it in terms of their perspective. I mean, this is kind of like with everything, right? So when you're going to talk with an investor, try to figure out what it is exactly that they're looking for in the companies that they invest in, because you can't just go and, say, hey, this is my company. It's great. It's the best. I need $1 million so I could invest in it and make it into $1 billion company. That's all fine and dandy, but you need to actually figure out what it is that person that you're talking with wants. And so maybe they're looking for a specific type of investment in a specific industry that has a specific kind of team makeup that has been around for X number of years. Maybe they have, you know, $1 million plus in revenue and that sort of thing. So it's going to take a little bit of homework on your part and a little bit of, you know, extra work beyond just looking up potentially, you know, the investor's website to really figure out who they are and what they want. And I think that kind of advice, you know, translates over to a lot of different parts of life in general, right? So if you want an investment from an investor, really get to know them well. You know, beyond that, you know, in that process of getting to know the investor well, you're going to find out whether or not you actually really want to work with that investor. Because that's also a big pain in the ass a lot of the time, right? So there's a lot of investors that really want to get involved and kind of try to micromanage from afar how your business is operated, what you're doing, and you don't want that. But maybe you do want an investor that is involved in some way. Maybe they want to advise you, or maybe they have experience that's relevant to what you're doing, or they have connections within the industry. That sort of stuff. So do your homework on the investors. I mean, just do your homework on all this stuff, really. I mean, it's kind of advice that I think is applicable across the board. So whether it's an investor or a potential customer, potential partner, a person you're thinking of hiring even, you know, just get to know them as well as you can. And I'm not saying, you know, spend a week getting to know every last investor you're going to talk with, but, you know, put in some of your own due diligence into the process. So it's a two-way street.
All right. Well, again, thank you, Travis. Really appreciate everything that you've been teaching us here.